There's a lot happening right now, and if you've been watching the market lately, you've probably noticed how wild things have been. The S&P 500 has surged, then stumbled, stocks have soared, then pulled back, hard. Volatility has returned with a vengeance, and none of this is random, it's not just noise. There are some very real reasons behind these moves, and if you're investing, managing a portfolio, or even just trying to understand what the heck is going on, you need to know what's driving all this action. In this script, we're going to unpack 3 massive developments from the past week that are shaping everything in the markets right now, and could have long-lasting effects for months or even years to come: Trump's big beautiful bill, and what it means for the U.S. economy and national debt, the sudden bond market volatility that caught many investors off guard and rattled the equity markets, the possibility of privatizing Fannie Mae and Freddie Mac, and how that could shake up the housing market and mortgage rates in a big way. Let's break it all down, fact by fact with no fluff. Trump's big beautiful bill, massive tax cuts, soaring debt, and what's coming next. Let's start with the BBB Trump's new one big beautiful bill, which was unveiled recently and has immediately stirred debate in both financial and political circles. It's big, it's bold, and it could blow a hole in the federal budget the size of the Grand Canyon. Here's what's in it, and why it matters. A quick overview. The bill is projected to add $3 to $3.5 trillion to the U.S. national debt over the next 10 years. That's a staggering figure, and it would push the U.S. debt to GDP ratio to over 125% by 2035, a level never before seen in American history. Now, let's go through the 4 major pillars of this proposal tax policy. The cornerstone of this bill is a sweeping extension of the 2017 Trump-era tax cuts, both for corporations and individuals. The cuts that were initially set to expire in 2025. Under this plan, they're now permanent. Corporate taxes stay lower, keeping the headline federal rate at 21%. Individual income tax cuts from 2017 remain in place, with adjusted brackets and expanded deductions. New tax incentives are being introduced to promote U.S.-based manufacturing and, perhaps controversially, fossil fuel development. The total projected cost of these changes alone, over $3 trillion in lost tax revenue over the next decade. From an investment standpoint, here's the trade-off. In the short term, corporate America might love this. Stock buybacks, higher profit margins, increased EPS, all likely, that's bullish. But in the long term, losing trillions in revenue while increasing debt makes the financial foundation shakier. It could mean higher interest rates, greater inflation risks, and less flexibility for future stimulus. Spending priorities. On the spending side, this bill takes a very clear direction. Defense spending is ramped up with big investments in cybersecurity, missile defense systems, and a Pacific naval expansion to counter China's influence in the Indo-Pacific. Border security and immigration enforcement get significant funding increases, but to offset some of that spending, several areas are being cut, including climate and renewable energy programs, diversity, equity, and inclusion (DEI) initiatives, public broadcasting, the arts and humanities programs. This is a major ideological shift in federal priorities, from social and climate initiatives to military, security, and fossil fuels. It's a reshaping of the U.S. fiscal blueprint, and it's going to have consequences across sectors. Social programs. Now this is where things get even more controversial. The bill introduces work requirements for several major welfare programs, Medicaid, SNAP, and Section 8 housing vouchers. It also proposes block granting Medicaid, which would cap federal contributions to the program and shift more financial responsibility to the states. Student loan subsidies and education grants are also cut back significantly. This could create real financial stress for low-income Americans, but it could also curb long-term entitlement spending, a political and budgetary goal for fiscal conservatives for decades. The fiscal outlook. Here's the bottom line. The U.S. national debt is projected to increase by $3.1 to $3.5 trillion over the next decade under this plan. The debt-to-GDP ratio would exceed 125% by 2035. Interest on the debt could exceed both Medicare and defense spending by 2030. That last point is shocking. Just paying the interest on the national debt could soon become the single largest line item in the federal budget. This isn't just a number on a screen. It's real, long-term economic drag. Timeline and what's next. Here's what we can expect next if this bill continues to gain traction. Next 2 to 4 weeks, Senate budget hearings and debate begin. By summer or fall 2025, possible floor vote in the Senate. By November 2025, election season heats up, and the bill could become a major campaign issue. late 2025 or early 2026. If passed, implementation could begin, changing the investment and tax landscape in a massive way. For markets, this is a double-edged sword. Some sectors could boom, especially defense contractors, industrials, and oil and gas. But the rising deficit could increase long-term treasury yields, and that's exactly where we turn next. Part 2. The bond market just flashed a warning light. If you blinked this past week, you might have missed it. But the bond market just went through a mini meltdown, and that's not something you want to ignore. Long-term U.S. Treasury yields jumped sharply after news of the Trump tax plan, and then things got even more intense when Moody's downgraded the U.S. credit rating outlook. What happened? Investors took one look at the fiscal implications of this proposed bill, especially that $3 trillion debt expansion, and started dumping long-duration bonds. Why? Because rising debt and higher deficits increase the risk of inflation and repayment uncertainty, especially for long-term lenders. Here's what we saw. 10-year Treasury yields jumped from under 4.4% to over 4.7% in just a couple days. 30-year yields surged, and bond prices dropped sharply as investors sold off. And remember, bond prices move inversely to yields. So when yields rise quickly, it means bonds are falling, and fast. The Moody's credit rating shock. Then came the second shoe. Moody's revised its outlook on U.S. sovereign debt from stable to negative. That's not a full downgrade yet, but it's a huge red flag. Why does this matter? Because when a major ratings agency casts doubt on America's ability to manage its debt, it sends shockwaves through global markets. Investors start demanding higher yields to compensate for perceived risk. So here's the thing, higher yields mean higher borrowing costs for the U.S. government, businesses, and consumers. And guess what? That tends to weigh on stocks. You could actually see this relationship play out in real time. As bond yields spiked, the S&P 500 dropped sharply. That's because equities and bonds are often inversely correlated during periods of interest rate volatility. If you were watching closely, or in my Patreon group, you'd have seen this in advance. Why this matters for you? Rising bond yields can ripple through everything. Mortgage rates go up, corporate borrowing costs increase, valuations on stocks, especially tech and growth, come under pressure, and dividend stocks may lose some appeal relative to safer, higher-yielding bonds. This environment favors sectors with strong cash flows, low debt, and pricing power. Think utilities, energy, and maybe even some defensive consumer stocks. But it's not a great setup for speculative growth or unprofitable tech. Part 3. Trump considers privatizing Fannie Mae and Freddie Mac. Now let's talk about housing, because this could be the sleeper issue that really shakes things up over the next couple years. President Trump has announced he's very seriously considering privatizing Fannie Mae and Freddie Mac, two government-sponsored enterprises that back over 70% of U.S. mortgage loans. This would be a seismic shift in how the American housing finance system works. Pros of privatization. Let's look at what supporters say this would achieve. Reduced government role. Privatization would shrink the federal footprint in the mortgage market and make home financing more market-driven. Taxpayer risk reduction. In theory, financial risk would shift from taxpayers to private investors, meaning less likelihood of a 2008-style bailout. Greater market efficiency. Private firms may innovate faster, respond more nimbly to changing conditions, and foster more competition. Windfall for investors. Hedge funds and institutional investors that currently hold shares in Fannie and Freddie could see massive gains if the companies go public again. The risks and cons. But there are some big potential downsides. Higher mortgage rates. Without the implicit government backing, investors may demand higher returns, pushing mortgage rates higher. Reduced credit access. First-time homebuyers and lower-income borrowers could struggle to qualify for loans. Systemic risk. If not regulated properly, a privatized Fannie or Freddie could fail and trigger another housing crisis. Legal and political complexity. Privatization isn't simple. It involves layers of federal oversight, court rulings, and congressional input. Market shock risk. The transition itself could destabilize the $12 trillion U.S. mortgage-backed securities market. What would happen to home prices? Here's what economic modeling suggests. Short-term, which is 1 to 2 years post-privatization, mortgage rates could rise by 0.3% to 0.7%, leading to a 2% to 5% decline in home prices. First-time buyers would be hit hardest. Mid-term, meaning 3 to 5 years, the market might stabilize. Demand could shift from ownership to rentals, pushing rents higher. Long-term, over 5 to 10 years, home ownership may become more exclusive, with low-risk borrowers unaffected, but higher-risk borrowers pushed out or funneled into subprime-style loans. This could widen the wealth gap and create a two-tier housing market. Final thoughts: prepare for the next phase of the market. All three of these developments, Trump's massive tax and spending plan, bond market tremors, and potential housing finance overhaul, are deeply interconnected. They affect interest rates, investor psychology, consumer spending, home prices, government debt, and even the Fed's next move. Here's the takeaway. Short-term, markets could rally on the promise of tax cuts and pro-growth policies. Medium-term, rising debt and higher yields could weigh on both stocks and bonds. Long-term, we may be entering a fundamentally different era of interest rates, credit markets, and federal budgeting. Stay informed, stay flexible, and most importantly, stay invested intelligently. I'll keep updating you as these stories evolve. And if you like this breakdown style, let me know in the comments. I'm considering making more of these rapid, high-impact investment updates part of the regular content rotation. In the meantime, check out one of the other deep dive videos I've posted, and I'll see you in the next one. Keep investing simplified.